Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1M1M is the first and only global virtual accelerator in the world for startups. We run it out of Silicon Valley, but with a global footprint. Our mission is to help a million entrepreneurs reach $1 million in annual revenue and beyond, build $1 trillion in global GDP and 10 million jobs. And in support of that mission, we do these free mentoring roundtables week after week after week for years and years and years. This is the 303rd 1M1M roundtable for entrepreneurs. And the event is being recorded. You will find the recording on our YouTube channel as well as on the blog. If you're live tweeting the show today, please use hashtag 1M1M. And our Twitter handles are at 1M by 1M and at Stromana. The YouTube channel is 1M1M Roundtables, and you'll find recordings of all our prior sessions at that channel. These are the teleconference call-in instructions. I will put this up when we are ready for call-ins. We're going to start first, actually, with a set of presentations. I think we have 3 entrepreneurs who have sent in their slides. We're going to work with them first. Now, to all our presenters, I want to do some expectation setting as you are beginning your presentations. Remember, this is a working session. We are here to work with you and help you move forward to the extent that we can, and we are completely on your side. I will do my best to tell you what I think you need to hear, which is candid feedback and direct feedback. I'm not going to try to sugarcoat it much because I'm not good at that. I'm good at analyzing businesses and, coming up with strategy that is going to be appropriate for your situation, but I'm not very good at sugarcoating feedback, so I'm not even going to go there. But please understand that the intent of the whole project is for us to be on your side and to help you move forward, make progress, and eventually succeed. So in course of this discussion, the interaction that you're going to have, if you disagree with the feedback that you get today, don't feel bad about it. All this is an interactive process. We all come with points of views and our own experiences and so forth. All I ask is you give some consideration to the feedback that you're going to get here, because this feedback is usually not off the cuff. It's based on methodology. It's based on, huge amount of experience that over 700 successful entrepreneurs have brought to this forum and shared and, very abundantly, very generously explained what strategies have worked, what strategies have not worked, and the feedback you get typically is based on that extensive body of research and feedback from experienced entrepreneurs. So that's why I request that you take the feedback seriously and do give it some consideration in your process. And if you're not pitching, please participate by asking questions in the chat. Asking good questions is how you learn. So it's important that you engage, ask questions, etc. We're going to start with Puneet Patel from Birmingham, UK. Puneet, please unmute your line and tell us what you're working on. J-O-B.
Hi, Shomana.
Service society.
Hi, Shomana. Good morning over there. Here it's in the afternoon.
Yes.
I heard about thanks a lot for the intro, and I heard about you through a course I'm doing. It's presented by John Mullins, and it's I'm essentially bootstrapping on a paycheck, and I love the fact that you actually advocate that, because it works for people who need to earn money on the side, anyways. But if we start with slide 1. I'll just explain what the business is in a one-liner. Okay. So the business is, we've called it Job on Buddy. That's, subject to change or whatever, but it's essentially a mobile-based temporary staffing platform for blue-collar jobs. Blue-collar jobs I define as, the low-wage, low-skilled, and high-churn jobs. The ones that are within the construction sector, retail, hospitality, office, nursing, and such. It's a big sort of area. If we just move on to the next slide, I can talk about the team. So it's essentially me and a friend of mine who's the co-founder. Myself, I'm a chartered accountant, an ex-management consultant from Deloitte, but I've also set up a restaurant in India in the past and recently set up a daycare nursery for my wife. I'm a new father. I love cricket and tennis. And my co-founder, who I've known for 10 years, he's actually a software engineer and developer. He's worked on large clients for doing database management, electronic form design, CRM, and he's developed a couple of Android apps on timesheets and travel expenses, given he's gone freelancing. He just loves his driving games and tennis, and I think the tennis is the thing that binds us. If we just move on to the next slide, please. So if I start with the customer and the market, so this is a high-level research that I did. So I've identified the customer as the blue-collar customer, as the low-wage, low-skilled, high-churn customer. And I've identified this market in particular because it's highly fragmented. For example, there's 174 Birmingham agencies, recruitment agencies for temporary staff who just deal in light industrial. That is a huge number. And when I scale that up to all temporary agencies with sort of blue collar, the number comes to about 350 agencies just in Birmingham. The temporary staffing market in the UK is 28.5 billion turnover business. 61% of that is in the blue collar industry. I've taken these numbers from a Rex report. It's a year old, 2014-15. And also, this temporary recruitment and generally employment is a heavily regulated industry. In the UK, there's something called the Agency Workers Regulations. In Europe, there's something called Working Time Directive. I'll come on to that a bit later. I've identified our customers as people who want flexibility. So they might be students, apprentices, mothers, new parents, elderly, people with disability, long sickness, etc. And I've identified what they want. They want empowerment, transparency, flexibility, choice, and security in employment. And I've identified on the employer side who the critical people are. And they are actually the business line managers, not the central HR, not procurement. They are the ones at the core face of the business who understand what they want and when they want it. And they actually want transparency, reliability, competence in the worker. They want to know that there's compliance. They want it at a low cost, and they want it as a 24-hour service. If we move on to the next slide, please. So this is the current problem, and the way I validated this is I've interviewed a lot of childcare businesses, and also through personal experience, and also interviewed a lot of staff. And the problem that I've come to is that agents, actually the number one problem is that they make the market opaque. So they don't let the workers see the business or the business see the workers directly. They also only focus on the business side of things. So if the business wants somebody and they want somebody now, that risk or that requirement is passed on to the workers, and they manage worker supply, i.e. they can hold people off, or workers are now passive participants to wait for a phone call from a recruitment agent. What all this means is that the worker actually just gets unhappy. They have no visibility of the market. They're just passive. They don't feel fairly remunerated. A lot of people have said that they fear blacklisting by the agent. They feel they have a sense of powerlessness, and they don't feel like they have security in the job or the opportunity to make a career change. Whilst the businesses get frustrated because they get unhappy workers, and they don't have visibility. They have to have multiple agents on their books at any point in time, which they frantically call one after the other, and they only operate in office hours. And all of that results in the recruitment agents being able to charge high commissions. The agents do actually provide a service in that they do provide compliance, payroll, and regulatory service, and that is something that I'll come to in a bit. If we move on to the next slide, please. So my solution to all this, as usual, is cut out the middleman. But it's not as simple as that. So I want to create a platform that actually makes the market transparent, that takes both the business's criteria and the workers' criteria just as important. I want this platform to centralize compliance, regulatory, and payroll, the very essence of what secures the worker, but I want to decentralize everything else. So I want to decentralize pay scale, although I want to obviously keep it above minimum wage, etc., and enable the worker to make choice. What this enables is that the worker becomes engaged. They see a fully transparent jobs market. They can actively participate in that market. They can see where the wages are. They feel empowered. They feel like the app can provide security in payment. They're given choice and flexibility, and they can work with people that on a ratings basis, for example. It gives them a lot of opportunities.
Puneet,
yeah.
Question for you. Essentially, you are going to replace these agents and brokers with this platform, and you're expecting that the blue-collar job seekers, our workers, are going to be directly interfacing with the businesses through your platform. So you are making enemies of the agents and brokers, yes? Essentially, yes.
I feel like at the lower end of the market, the workers are underserved, and I don't think that they're allowed to actively participate in their own career or job seeking.
Okay. So it's essentially very much like an Elance or an Odesk, but it's a marketplace. However, it's focused for these blue-collar temporary workers.
Yeah, and in particular, I've actually picked childcare just because of the complexity in that industry. Because I feel like if I can crack the complexity in the vulnerable persons market, then I can scale that up later into different markets and actually add more value.
Okay, so that puts you in competition with stuff like care.com.
Well, in the UK, I think when I've looked at the childcare industry, it is really fragmented in that there's a lot of local agents that come into play, and local nurseries use local agents, even if they're a national nursery. Like over here, there's something called Busy Bees. Each nursery manager will have a local sort of agency contact.
Okay.
But it's,
so you were saying that you're not providing child care to the consumers, you're providing child care to the nurseries. The temporary staff, child care staff to the nurseries, not to the consumers.
Yes.
Okay, got it. Okay.
Yep.
And how big is the market, do you think?
Well, the actual total market is about 17.5 billion for all of blue collar. Within childcare itself, the percentage, the actual total by turnover number comes to about 750 million.
And you are going to get, what, 10% of that?
Well, yeah, I mean, that's by turnover. The margins currently operating in the childcare business is 40%. So let's say about 400 million.
No, my question is, what is your business model?
Well, to be honest, I'm looking at starting.
You get paid a percentage of the contract value and through this platform?
10%
so and that
commission.
standard is about at most 10%, right?
Yeah, the 10% commission. I've got the monetization bit at the end.
So, okay, so it sounds like, well, why don't you keep going, and I'll talk to you more about that when we get to monetization.
Okay, thank you. And the other thing that the solution provides is the businesses actually save both time and money. It's part of the transparent model, access to the market, 24-hour access and all this. The opportunity for the line manager really is they can have who they want, when they want, and at what cost they want. If they want someone urgently and there's no one available in the market, they might have to increase the price, but the price can be cleared by a worker who wants to work at that time. If we move on to the next slide, please. So we've got challenges and remediations. I think you're on a competitive advantage. One slide back, please. Another one back, please. Right. So on the challenges and remediations, so I've identified a few challenges that this business will face, and the main ones are the regulatory and legal, software and data, and market and trust. But I've also tried to identify some remediations, which I've kind of worked through by talking through agents and looking at how we've hired in the nursery in the past. From the regulatory perspective, I would want to build a secure document storage, minimum wage criteria, onboarding via past references, and monitoring time spent on jobs, and obviously building terms and conditions in accord with employment law. On the software and data part, the most important thing is to have the secure backend for data protection, because we're dealing with people's information, and also to have a strict onboarding process. So make sure that people have the right qualifications, they have the right references before they can actually enter. And then we're planning on building a matching tool to match by location, availability, industry, and wage. And to be honest, we need to hire developers when we're ready to scale. At the moment, we want to start small and stay small and see if the concept actually works. In terms of market and trust, we're actually only going to focus on childcare in Birmingham at the moment. And then we want to try and build and optimize the market in tandem between the employers and the job seekers. We're going to do a weekly payroll and invoicing cycle. We're going to do on-site timesheets. We're going to try and provide convenience, security, transparency. We're going to provide ratings based on 5 criteria, and we're going to also enable penalties for misbehavior. In case, for example, a worker cancels, there'll be some sort of strike policy that creates a penalty effectively.
Okay.
If we move on to the next slide, please. So the current market, competition in this market is twofold. There's a traditional model, which is agency-based. It has all the problems of having an opaque market. However, as this model has moved on, it's gone from local agencies to master vendor contracts to these things called neutral vendor contracts, and there's a decreasing cost to the business the entire way. However, the neutral vendors and master vendors have actually centralized the hiring decision process into central HR and procurement in organizations, and taken that decision away from the actual business line managers. And the other part of the competition at the moment is a really fast-growing area of mobile-based. And there's 2 companies in the UK that I've seen that are real competitors. It would be Catapult. They only work in retail, hospitality, and office, and they do video profile. They have no document storage. And they work in retail, hospitality, and office because they're more simpler, or they are simpler to onboard staff to. Similarly, BuzzHire is new. It's an on-demand staffing platform, but they have their workers as freelancers. And I have a personal feeling, although I haven't really explored that much more than this, but a personal feeling that blue-collar workers as freelancers miss out on the opportunities of, regulatory safeguarding, such as holiday pay, pensions, and the such. And I think that they could be kind of, in UK term, taken for a ride. Could we move on to the next slide, please? I feel like the app or the platform would have a competitive advantage because of its unique platform in the secure document storage, timesheet, payroll, audio statement, past references, onboarding process. But I think that there's also a competitive advantage because I'm entering and I want to compete in a challenging industry where there are regulations, where there is data issues, where it is highly competitive, where there's local demand requirements and government intervention might happen, and there's existing vendor contracts that might need to be reassessed. And I think that to grow, I think, in the future and to retain this competitive advantage, I'd have to go two fronts. One is to expand the scale and scope, new locations, new industries, but also expand the capability, so offer more stuff like expense tracking and holidays. But my personal sort of goal for this app would be to actually develop the workers themselves, to build training into it, and potentially in the future build a permanent staffing add-on. So permanent staffing could be done free, and it enables workers to go into full-time employment and for businesses to take them on full-time employment without paying any agency fee. And in my personal sort of view, permanent is better than temp, but I don't think that would affect the business itself. And it might get government agencies on board. Can we move on to the next slide, please? I already have 10 nurseries as early adopters and have identified a potential of 347 nurseries in the Birmingham area. I expect a conversion to 50 nurseries by sort of June 2016. On the supply side, on the worker side, I'm looking at building a strategic partnership with the job center and targeting universities and colleges specializing in childcare. And I've been engaging with current temporary staff at existing nurseries and the 10 nurseries, and I have 15 people on board for early adoption who I can now start pushing out to these different 10 nurseries. Right now, I'm just kind of working on Excel and kind of running through everybody, so really staying small at the moment.
Are these paying, the nurseries that you have as early adopters, are these paying customers or are they just,
Yes.
What are you charging them?
And the reason, so I charge them 10% above the wage plus the employer's national insurance plus holiday plus pension. I charge them 10% commission. But in reality, I'm actually beating the next nearest competitor, which is charging 40% commission. So these nurseries are quite happy to let me do this, and I'm actively managing or actively putting in front of them these the different people that I've got on my books to say, you can have these people for X amount of days or however many days you want, and then you can pay me and I'll pay them. So I'm running that. Just one slide back. I just wanted to talk through one thing that I might have to ask you.
We have several other people that I have to work with, so this is already, you've already gone quite a bit, so we're going to need to speed up. If you want any feedback, that is, so far you have spoken, I haven't given you any feedback. So I think we should focus on where you would like feedback and what your questions are.
Okay, just quickly, I might need to working capital gap filled with funding. And 10% job commissions is how it's going to make money. And the main thing that I want feedback here on is I understand in the matching market, the biggest problem is the execution risk of building your supply and your demand. And how would what next steps would you say that I should take to, one, build my case, and two, to build a matching sort of company?
So, if you're bootstrapping with a paycheck, the only kind of financing you can access is friends and family financing. There is, professional investors would not fund the bootstrapping using a paycheck situation. Plus, you don't have validation yet, or enough validation against which you can actually raise a full seed round. You have to, get to significantly more validation. And I think there's one question that's coming to my mind as I listen to you is that there's a fair bit of software development that needs to happen for the kinds of functionality that you want to provide for that to work. Have you done anything to put that software in place? Do you have any strategy on that?
Well, I'm working with my sort of co-founder, Tone, and he's more sort of looking on the software side. I'm kind of looking at the more strategic side of things, but no, I haven't. I have to give that a lot more thought.
Because if you're, what you're proposing as your differentiation is document sharing and stuff like that. And first and foremost, you need to understand from the nurseries if that differentiation is of interest to them. That is part of the validation exercise. For the moment, you're going to have to, your working capital has to be provided by yourself or friends and family. There is no professional financing that is viable at this point where you are right now. So you're going to need to come up with, strategies of how you can plug your gaps or how you can structure this business from a milestone point of view, from a project and task point of view, such that you can get to a level of validation that might get you to financing. But, and there are many other factors that need to be worked out, one of them being TAM, which is what I was getting at when I asked you, what's the, total, what is the size of the market in the UK? You're saying the childcare market is $750 million. Not all of it is going to come to this online mode, but nonetheless, your market is 10% of that. If 100% comes to this mode, then your total available market for that space is $75 million. 100% is not going to come. Let's say, 30% is going to move to this mode. So you're working with a relatively small market. Of course, you're going to go to other segments eventually, so that's not your only market. That's a piece of your market. That's your market entry strategy. By the way, I love the fact that you have picked up one segment and you're really going deeply into that segment and fleshing that out. But as a part of the validation exercise, you need to understand what are the requirements of that segment, and what you are proposing as differentiation, is that of interest to these nurseries. And you need to get these nurseries into a paying customer mode as soon as possible.
Okay, yeah.
So that's, that's pretty much a summary of what I think you need to do next.
Okay, yeah. I mean, that's really good. And I was just, I found you guys on that course, and I've been reading about it, and I really love the way you guys work, and I just wanted to see how this worked out, because I've got other sort of pitches that I've got going, but I'm now thinking that I'll probably kind of join up and get more information from you and build on this, actually.
Please do. We'll be delighted to work with you, and this is a very extensive, comprehensive, exhaustive program, so will be pretty much everything you need at this stage of the game we will be able to provide you, and it's a very inexpensive program, and as you probably read about it, our goal is to democratize this mode of entrepreneurship education and acceleration as much as possible. So you're very welcome. I will talk a bit more about the program and how it works after I finish more of the entrepreneur presentation. So hang on. If you could have questions, you can ask questions later on in the program as well.
Well, anyway, thank you a lot for your time, and I'll sign out.
All right. Terrific. So we have next Ajay Thakur from Bangalore, India. Ajay, please unmute your line and tell us what you're working on. Ajay, are you there? What's happening? Ajay's phone line?
AJ, you need to speak up. He's on the call.
What's going on, Ajay? What's wrong with your phone? I can see his phone line is on. You can hear me, but you need to speak. You don't say anything. Unmute is not working. What do you mean unmute is not working? You're already unmuted, so just speak. We cannot hear you, so he's muted somehow, Maureen. Well, I think I'm going to move forward to KB Lee while you sort out your technical issues, Ajay. I'll come back to you. KB Lee, please unmute your line. Let's work on yours. Calgary, Alberta,
Hello.
Canada.
Yes, Sumana, how are you?
All right, and you?
I'm awesome, thank you.
Go ahead, tell us what you're working
Great.
on. Ever Bamboo, that's an interesting name.
Yeah, Ever Bamboo, Rethink the Think. So I'm the founder and CEO of Ever Bamboo, based in Calgary, Alberta. Next slide, please. So we manufacture a line of natural deodorizers and dehumidifiers made from bamboo. It's actually bamboo charcoal, to be exactly. And so Ever Bamboo is our brand, and we have been working on this since 2007. Next slide, please. So, Sumana, do you know what are the ingredients in a typical air freshener?
No, I don't.
Yeah, there's actually over 80 ingredients, and most of them I can't pronounce. It's filled with petroleum-based chemicals and formaldehyde. They're very toxic, and in most cases, the ingredients are not even listed on the packaging. So consumers don't even know how toxic they are and how harmful they could be. And on top of that, they mask the smell with artificial fragrance instead of eliminate them. So we have a better solution. Our slogan at Ever Bamboo is Rethink the Think. It's all natural, unscented, one ingredient with bamboo charcoal, and it's ideal for anything stinky and musky, like shoes, gym bag, fridge, closets, drawers. And bamboo charcoal is produced from the rapidly growing Mosul bamboo. That's why they are sustainable, and they are very effective because they're very porous. They have 10 times more surface area than regular charcoal, and they're 4 times more powerful. So they are very effective deodorizer and dehumidifier. Our mission
I have a
is to make the
question,
world.
KB.
Yeah.
When you're saying it's both a deodorizer and dehumidifier, are those both characteristics always true, or do you have an option? Does the consumer have an option to use it as a deodorizer and not a dehumidifier? Because sometimes you're in environments where you don't really, it's a dry environment and you don't really want a dehumidifier, you just want a deodorizer. But does this do both at once?
Right. As a dehumidifier, it absorbs excess moisture. So if the environment is dry, it won't work as a dehumidifier too, because there's no excess moisture. The product itself works as both a deodorizer and a dehumidifier. Right. So our mission is to make the world a little less stinky, one odor at a time. So we have now over 700 retail locations carrying our products throughout U.S., Canada, and Australia. So retailers such as the Container Store and Taylor Guitars, and then also Spot Check in Canada and Office Works in Australia. So we also work with online retailers, and then we also sell online on our own website. And
awesome.
Recently, we sell on Amazon, Seller Central, both in U.S. and Canada, and then some other platforms as well. So we have been kind of grinding, hustling for many years, running at a loss. Our big break came in August 2014 when our products were featured on The View by Whoopi Goldberg as one of her favorite things. So that generated lots of consumer awareness. In a 2-month period, we got 600 online orders in 2 months. So now I'm the sole owner right now. I own the company 100%. I'm actually I'll be pitching on Dragon's Den next week, which is the Canadian version of Shark Tank. So,
how many? What is your revenue level based on? You've been in business now for almost 10 years. What is the revenue level?
We're at around 200,000.
Okay, so 200,000, and you said it's not profitable?
No, not right now. Like, we have been running at a loss for the first 7 years. We had a little bit of profit for the past 2. Actually, for 2 years ago, we had a little bit of profit. Last year, we were at a loss again because I invested a lot into the branding. So I assembled a team together last year to come up with the branding, a new logo, new slogan, copywriting, and things like that.
And how many customers do you have on the e-commerce side?
You mean how many orders have? It's hard to say.
Yeah, how many orders, but more how many customers? How many customers have placed those orders? Not unique orders, but unique customers.
We have our mailing list is about 1,000 people that subscribe to our newsletter, and most, like about 70–80% of them are our customers, and then obviously there are customers that did not subscribe to our emailing list. So yeah, we have like this.
So one thing you could do for your marketing is to do a crowdfunding campaign, and in products like yours where you basically take advance orders, and you can build a business just by taking advance orders. So if you go into your 1,000 customers and start there, and then use the Kickstarter, either Kickstarter or Indiegogo, and develop awareness within that community as a natural product, that may be one way to generate awareness in a very cost-effective way.
Right, but those customers, they know about our products already.
No, they're not your only customers. You're going to need to use those customers to kickstart your crowdfunding campaign. But then once you do that, there's also a very large audience of customers on Kickstarter itself or Indiegogo itself, and you will also get awareness. If your campaign starts to, look interesting, there will be more people who will be made aware of the campaign because of the platform. Right.
Okay.
So look into that. That may be one, possible way of, navigating this.
Right. Yeah, sure.
Okay. So that would be my first idea, and then otherwise I'd need to take a look at your business at more depth and work out strategies of a full-fledged customer acquisition strategy beyond that, and be happy to do that in the program if you like.
Right. How about valuations? Like for a CPG company, what kind of valuation metrics do
your company is not fundable, KB. So let's not even talk about valuation. You build a $200,000 revenue loss-making company in 10 years. That is not a fundable company at all.
Okay.
Okay.
Thank you, Sumana.
You're welcome. You're welcome. Maureen, whom should I go to next, Ajay or Ho? I know you're working behind the scenes on the technical issues of both, so could you please advise me where should I go next?
Hello?
Yeah, just a second. I need to get some guidance from Maureen. Okay, let's do Ajay then. Ajay, are you able to?
Yeah.
That's you, right, Ajay?
Yeah.
Go ahead.
You are able to
Go
hear
ahead
me
with your
now?
presentation. Yes, we can hear you.
Okay. Thanks. Now finally thing is working. I'm Ajay. I'm 21-year-old founder and currently building Bameslog, the world's first hybrid platform. I'm delighted to be here. And can you please switch to the next slide? So basically, what are the problems, right? The most of the internet users, spend around 30% of their time finding right content. They just keep scrolling on, and still they don't find the time. So we decided to, fix this problem, why not to work on it. And the second problem is data. People don't know, what kind of data they are consuming, what's going inside their mind. There is no platform, that provides such kind of insight, because as a internet consumer, I should be, aware about, what kind of content I'm consuming. And the third and last, I guess the problem is place. Still the content consumers and creators don't have, one simple unified place where they can share and consume content. So that's pretty much we are trying to solve. And can you switch to the next slide, please? Okay, so how are we going to solve this problem? So we are solving the time scrolling problem, where users don't have to waste their time scrolling through AI and machine learning. And our user has been telling us that it is irresistible to when they sign up, it's irresistible to log in and keep scrolling, because they find content so relevant and related to them because of AI. And the second problem that I told you was the data. With the help of the knowledge graph, people can know their knowledge inside actually what's going to your head. When they are using Bameslog, they come to know actually, okay, what's their digital personality online. For it's 80% of entrepreneurship data is going in ahead, or 20% of sports, and so on. And the third problem we solved through hybrid nature, right? We wanted to build a platform that is not entirely a knowledge platform, or neither entirely a social platform, but cross-pollination of both. So people have, one place to share their content, to consume the content, regardless what the content type. It can be videos, photos, images, but in perspective to their interest and personalized delivery and some kind of a social connection where people can, don't get bored. They can have, some kind of possibility of having both the networks in one platform. Next slide, please.
So Ajay,
yes.
I'm going to give you some feedback on this first slide and your pitch, okay? So you started this presentation, and we've spent about 2-3 minutes on this first slide, and I understood absolutely nothing. So let me give you some guidance on how to pitch this. You should pitch this with a use case, a before and after use case. And you should think about a consumer and a particular use case of what is that consumer looking for? Where is that consumer going to look for that information? How is that consumer behaving, before your product? And then show us how that consumer is going to behave after your product is brought into the system, and how is that user behavior going to change? What is going to be the outcome of using your product in that scenario? Do you understand what I'm saying?
Yeah. So thank you for your feedback. So let's crunch down to more simpler way. As a common internet consumer user, if I want to pursue my interest or consumer content to same kind of interest, why as a user I should download Instagram, YouTube, Blogger, or switching back to 4 or 5 apps? Why there should be one product where I can get this all thing? That's the most simpler way I can explain it. Not having 4 or 5 apps instead of having one app for every type of content consumption. So let's get back to the market side. So this market research has been done in 7 days, through the internet, and So we currently found that there are around 2 billion people who consume content every day, photos, articles, videos, and almost like 28 million content creators there are online, and 46.6 million are from India. And globally, we have like 28 million. And from India, the 396.6 million content consumers are from India. So we think this is the huge market to get on, and there is still a lot of space to connect. And market validations, like we have like a local competitor here, Witifeed, but they are not even closer to us in terms of product, the technology we are using and everything else. And when you look around, we have like 1.5 billion users, untapped market for platform like us, where people can share content and consume content, and this market is growing every day. Next slide, please. And why we should be, what kind of competitive advantage we have? The first thing is we are first hybrid platform to enter market, and second is we are one of the first hybrid platform to have AI and machine learning. And then we have knowledge graph, and this knowledge graph will enable user to see knowledge inside first time in internet. And because we were using our technology when we were building, we wanted you to be, it to be future sportive. So our platform is already AR, VR ready, so people can, actually consume content like they can feel, they can jump into a book and, read and feel they are part of the story. And our product is really super vast. We actually compared our product with entire India media sites. It's performed really well. It's simple and easy, and also the global products. It's fast, and again the singularity concept. One place for all kind of creators. If I'm a photographer, I don't have to go to some another site. There should be a place where I can upload videos, write content, and share my photos and make money out of it. Next slide, please. Okay, so we launched our product back in August 2015 with 1.5 million lines of code, and till now we have like 46,000 monthly active users, and we are crossing 500,000 views each year. And we're going to launch our apps in next 2 months, and by the end of April 2017, we are targeting to cross like 5 million users. Next slide, please. Okay, and so what we have achieved so far. So basically, we were working in stealth mode, and we still are working in stealth mode. We don't promote anything. We just share publishers' content all over the ecosystem, and we have like 46K monthly active users and 500,000 monthly views, and our analytics just recorded 1.5 million user events, and our projected views would be exceed over 1 million in next upcoming month. So we already validated our product, and people loving it, and we don't have to spend anything to acquire users. Next slide, please. The business model is typically a simple, sponsored content, native advertising, and brand and partner in such a way so users don't get distracted in any way somehow, and that's the business model. Nothing special on it. It's simple to integrate, and everyone loves it. Next.
And how
slide,
much
please.
money are you making right now based on this business model?
Okay, if you put some display ad network or some kind of something, I guess we will cross around $30,000 per month. But because we are so focused on our content and users, we don't want right now, because we want to have our own display network, so publishers can also make money and users can also have better experience. So we don't want to go to Facebook Audience Network or Google Ads or something, because their business model is to make them rich, not us. So we want to have our own integrated business model and technology that will benefit entire ecosystem, and especially the place like in India, where a boy comes from a middle-class family and start writing blogs, and he finds so hard to make money because there is so much competition. So we also want to fix their problem.
So the answer is you're not making any money right now.
Yeah. Probably our making money goal is after 24 months or 12 months, because we want first more users to be a part of our community.
And how are you surviving in the meantime? Do you have funding?
No, we don't have funding. Actually, there is one of my friend, he doing a good job, you know, like he have a good amount of salary. So we are using his credit card in our server to support our server. Besides that, our entire team is working free from last 18 months. And that's pretty much how
Does everybody have jobs? Do you all have jobs, other jobs?
The 90% of team consists of young people. They actually in school or doing colleges, and 10% of people are doing jobs. But me and my co-founder Bhupinder Nair is working full time right now. And last, I want to end with my mission that we want to spread valuable knowledge in most effective, efficient, and beautiful way. Thanks.
And what is your question?
My question is are we going in a right direction?
You know, I don't understand your business. So from the presentation that you've done, you've spent a good, 10 minutes or more. I don't understand your business, and unfortunately, I'm out of time. So first and foremost, the first thing I would do if I were to start working with you closely is to, coach you on how to pitch this right so that people can understand what you are doing. As it stands, I don't think anybody understands what you're doing. So without understanding that, it's impossible for me to give you any other kind of coaching or guidance, because I don't know what is this business. So you need to really work on learning how to pitch this right, first and foremost.
Yeah, I guess so. But,
that's my first feedback.
Okay, thanks.
Okay. All right. That concludes the presentations. We're doing things a little bit in a different order than we normally do. We usually have our guests first and then the presenters, but today we've had presenters first, and now we have Ho Nam, Managing Director of Altos Ventures, as a special guest, and we will be spending the next few minutes talking to Ho. Ho, are you on the call?
Yes, can you hear me?
Yes, we can hear you. Fantastic. I'm so happy that we were able to sort out the various technical issues and get you on. So Ho, why don't we start by your introducing Altos Ventures and your core philosophy about investing. Obviously, it's somewhat different from other VCs out there, and I would like our audience to learn how you look at the venture landscape and how you and your colleagues at Altos have come up with a differentiated positioning for the firm.
Okay, great. Well, thanks. Pleasure to be here, and thanks for the opportunity. And been following you in your blog for a long time, so it's great to be here. So Altos has been investing in Silicon Valley for 20 years now, and several years ago we also opened an office in Seoul, Korea, which is where I'm from originally, and one of my partners is as well, and he's pretty much moved over there. And now we operate with 2 partners here in Silicon Valley and 2 in Seoul, Korea. And I would say that we've always taken a fairly consistent and pragmatic, what I would view as a rational approach to venture capital. But depending on where you are from and how what your perspective is in terms of how much capital to raise, how aggressive to be, we can be viewed very differently. So let me explain. I think in Silicon Valley, we're viewed as pretty conservative and very pragmatic. We stay away from the hot deals that take the big rounds at big valuations. And the funny thing is that in Korea, where we invest with pretty much the same approach, we're viewed as these aggressive Silicon Valley types. And in both places, our goal is very simple. We partner with entrepreneurs to build fast-growing businesses in a capital-efficient manner. And we, I guess the way we're different from maybe some of the bigger, other mainstream Silicon Valley VCs is we think it's dangerous to crank up the burn rates of companies too fast in early stage companies. We believe you hurt your chances of developing the discipline and the culture needed to build a sustainable business. And you can't change the culture of a company when you're 300 people and start telling people that, oh, now you have to be careful about how you spend your money because you're big and you're going to go public and you have to start to make money. It's much harder to change a culture of a bigger company than of a started right from the beginning.
Yeah. So, folks, as you know, those of you who are following this program for a while, we are huge believers in capital-efficient entrepreneurship. I personally believe that unless you have a Facebook or an Uber in your hands, for most businesses, entrepreneurs and investors end up making a lot more money if you can do a capital-efficient venture that grows fast and grows well but doesn't burn so much money so quickly that you end up with huge capital risk. So this is why I like what Altos's investment philosophy is, and we work with them quite often. And then I wanted you to listen to Ho's perspective, and he'll give you a lot more. Ho, what is your analysis of the investment environment currently? We are in, second quarter of 2016. We've just gone through this unicorn mania of 2015, and it has started to slow down. How do you read the market currently?
Yeah, well, the environment definitely was frothy last year, right? And all the talk of unicorns, and there's definitely less of that. People do seem more cautious now. I was talking to a good friend of mine who's at one of these very large venture firms yesterday, and they have a large, fresh new fund, but he's telling me that they're seeing valuations come down, and so even though they have a fairly small percentage of their fund invested so far, which was only raised last year, they're slowing things down because, hey, prices are going down. They don't want to be deploying too much capital in a downward pricing environment, and they want to deploy more capital, right? So there's that kind of attitude for sure, and I think things were getting a little bit too frothy last year. With all that said, what's a real head scratcher is, right, you look at the S&P 500, the stock market has been on a tear over the last 30 days, right? At the beginning of the year, it was one of the worst beginnings ever in January and February, and then the stock market has recovered. So if you look at the S&P 500, it's at 2,100 now. So that is within, I think, 1.2% of the all-time highs. So it's kind of strange, right? Because the public, if you're an public index investor, you're back to your record highs. But a lot of sectors have been somewhat devastated. You look at some high-flying tech companies.
At the same time, we're not seeing any tech IPOs at all right now.
Yeah, no, that's true. Yeah, and so the tech sector, I think, is suffering. You look at some high-flying companies, and these are very good companies like Tableau, which I know you've covered multiple times, and LinkedIn, amazing companies, great companies. Well, their stocks are pretty much, half of, less than half of where they were. And yet the overall stock market is close to record highs. Certainly many tech stocks are not nearly at record highs. But, it's a tale of haves and have-nots. Certain companies like Apple and so on and Amazon are almost back to their all-time highs, and other companies are still troubled. So I think valuations definitely got ahead of themselves. And so there are some very good companies that will do really well long-term. But, they're going through some adjustment right now.
Yeah. So let's switch back to our, sweet spot, which is the early stage venture game. Series A VCs these days are looking typically for a 1 million annual revenue run rate and 100% plus growth rate as the table stakes. If you don't deliver that, then you cannot really raise Series A, except in probably very, very rare exceptions if you have track record and blah, blah, blah. But if you're a regular founder looking for a regular Series A, these are the things that you need to come to the table with. Now, let's say a startup gets to that. What are the circumstances under which they ought to consider working with you at Altos as opposed to one of the larger VCs with bigger brand names?
Yeah, I think that's a good question. I think the answer is so situation specific. So we just signed a term sheet last week, middle of last week, and we won a deal against 3 other VCs. 2 of the VCs were clearly bigger than us. One of them offered more money, twice as much money, at a higher valuation than us. And so their pre-money, I think, was about the same as our post-money valuation. So why did the entrepreneur choose us? I think you'd have to sort of interview him. But I think the reason, and at least what he told me, was very deal specific. The founder felt that we had the deepest understanding of his business, and we saw eye to eye on how to grow the business. Again, it's very simple stuff, like building a solid business in the short term, in a pragmatic, capital-efficient way, while keeping an eye at the same time on the home run opportunity. And the reason we're investing is because of the home run. And this is a company we've been tracking for 18 months. And last year I was convinced that there was a home run opportunity. What I wasn't as convinced was, okay, well, how do we get from here to there, and how do we build a solid business in the meantime so we could afford to be patient and we don't go out of business, between here and there, right? And they've continued to make progress, and I feel good that, hey, look, we have a solid business, we could continue to build it, and I was already convinced that in the long term there could be a fantastic home run opportunity. So a lot of things had to come together for us to invest. I remember another instance where there was a firm where no VC wanted to invest because the deal was too small. The company didn't want that much, and we offered these guys a $2 million Series A financing. Right? And even for us, that's a little bit small. And we had to interview with the founder's father and his brother, who were both on the board. They didn't really need our money. We had to try to convince them to take our money, right? And when we submitted the term sheet, they came back to us and said, oh, well, $2 million is just too much money. Like, we'll take 1.5, right? We don't need your money. We don't need $2 million. So we invested 1.5, and the company has continued to grow. It'll hit a $100 million run rate this year. And we've continued to invest more as the company grew, right? And, they weren't convinced that they needed all that much money. But as you grow, you have needs for capital. And then last year we invested some money, late last year. It was $2 million just to give the founder some liquidity. Because, it's hard to grow a business, and you got, kids, it's expensive, peace of mind for his wife. So we invested even some more last year, and the company didn't necessarily need the money. But they're also being faced with large VCs coming in, offering big valuations, lots of money, and they're looking at, well, why do we need the money? Like, we don't need the money. We'll continue to grow it in a profitable manner. So we love working with entrepreneurs like that. It's great, and we're happy to invest more and more money, right? And when we see things going well.
Cool.
Yeah.
Let me actually point out something to our audience, which I think is a synthesis of what you are talking about here. I think the investment world or the startup world is kind of bifurcating between 2 completely different philosophies of business building. One is this capital efficient, organic business building. Even if you take some amount of money, it's small amounts of money, and being more conservative and being more fundamentals oriented in how you grow. That's one style of business building. The other style of business building is raise as much money as possible, drive your burn rate up as much as possible, and kind of swing for the fences without protecting your, fundamentals as much, without executing on the fundamentals as much. So, and there are all sorts of dynamics. There are large funds that can only do so many deals, and they need to do deals with large amounts, that deploy large amounts of capital because they need to get large management fees for these large funds, and so on and so forth. So that's the dynamic that's driving the latter kind of financing. Our philosophy is much more in the former kind of financing. We are very much in the capital efficient business building, fundamentals driven approach. Even if you raise a lot of money, our approach is that you need to do that at the right time with an eye towards the fundamentals. So I think
that's
there
right.
is a class of investors like, yep, go ahead.
And just because you're, being frugal and pragmatic doesn't mean you're forever being conservative, right? We had one of our companies raise $1 billion in funding last year, and we didn't need to raise $1 billion. We had $300 million of cash in the bank, right? And so we didn't need it, but we're taking advantage of the opportunity, raise $1 billion. It's a game over type of strategy. Or just earlier this week, we announced that one of our later stage companies just raised $50 million, and we are working very hard to get that company to profitability this year. And so we don't need the money, but we're going to be profitable. But as you build a scale business, adding another $50 million to the balance sheet to be prudent, to be opportunistic, that makes sense, right? So when you see something going well, you go for it. Like LinkedIn, I remember a couple of years ago, they raised $1 billion, right? Well, why did they raise $1 billion? Well, because they might want to do some acquisitions, and they ended up doing Linda. They had billions of dollars in the bank already, and they were profitable. They are profitable, or cash flow positive at least, so they don't need the money, but they raised $1 billion, right? So, as you build a business, it makes sense to, raise more capital and do those kinds of things, but you don't do it because you're desperate, because you're burning money, because you're going to go out of business without the money. That doesn't make any sense to us. We don't like to build businesses that way. You have to control your own destiny, right? And if you don't need the money,
right, and it's very difficult, as you said, it's very difficult to change culture midstream. If you're in the business of burning lots of money and living this kind of non-fundamentals oriented life, suddenly switching to a fundamentals oriented culture is very, very difficult. Whereas if you are following a fundamentals oriented culture and continue to deliver on revenues and profitability and so forth, adding money to fund acquisitions, adding money to maybe accelerate growth, open up new geographies, when you have good fundamentals, is actually relatively easier. A great case study is Atlassian, right? That's an Australian company that was always bootstrapped and profitable and raised money way later and has had a very successful IPO and has not changed culture. They continue to run the company with that fundamentals-driven approach, and these types of companies do a lot better in the long run. They're a lot more sustainable.
Totally agree. And you look at the Atlassian growth rate, and it's much lower growth rate than let's say Box.com was at the IPO. Box was growing very fast, over 100%, I think, and Atlassian was growing maybe only 40%. But you look at the multiples, right? Investors are smart. I mean, they know. Atlassian is trading at a very high revenue multiple, I think more than 10 times multiple, even though it's growing less than half the rate of Box. And Box, has lots of challenges in their business. So people get so obsessed with growth rate, and we need that to attract investor capital. And it's like that's not the only factor. And if you're obsessed with growth rate, I think that you could really get into trouble.
So switching gears again, you are one of the few Silicon Valley firms that regularly invest outside of the Valley. Tell us a bit about your global investment philosophy and how your firm views the opportunities out there. As you know, this is 1 million by 1 million is a global program.
Sure. Yeah, so even though we've been in Silicon Valley for 20 years, as I mentioned, over the last few years especially, we've actually invested more outside of Silicon Valley than inside. And it's not just global, it's also in cities like Austin, Texas. We just did a deal there, and we have a couple of companies in Vancouver, which is Canada, I guess, so it counts as international. And this week we just signed a term sheet for a company in New Orleans. Now, outside of North America, most of our attention has been in South Korea, and we now actually have 2 dedicated funds in Korea. So we used to invest outside of the U.S. fund has the ability to invest anywhere outside of the U.S. And we used to invest about 10 or 15% of our funds in Korea. Now Korea has gotten so big that we have separate funds. But we've also, in recent years, invested in founders that came out of Ukraine, Belarus, and Estonia. And we had always been impressed with the quality of engineers from that region. And now we're starting to see strong entrepreneurs who are starting to really build businesses there as well. I think, we can go into Korea, but there's some specific reasons why we like Korea. It's an interesting, overlooked opportunity. There's a lot of VC dollars chasing opportunities in places like China, not Japan, it used to be Japan, but certainly India has gotten very frothy. Israel, VCs, Silicon Valley VCs have always invested there. And so no one's really focused on Korea, but it's only one of 6 countries in the entire world with a high per capita GDP and a population that's more than 50 million people. And so 50 million is tiny compared to India and China, but it's a pretty significant population, especially when you multiply, with a high GDP and a population that has a very high propensity to buy on things online. They have the world's most advanced broadband and mobile infrastructure, very advanced education system, and so you could actually create pretty significant companies. And so Korea has produced more internet unicorns than any other country outside of the U.S. and China. And so we have some competitive advantages there because we have some Korean roots. And so most of our activity outside of Silicon Valley or outside the U.S. tends to be in Korea, but we're opportunistic. And like I said, like those Eastern European countries that we've invested in, we will look everywhere.
And what are your greatest investment successes? I know there's one unicorn from Korea. Would you like to talk about that? And particularly what I'm interested in is what stage did you invest in them? What did you see in them when they first came to you that looked promising, and what was the investment thesis? How did it pan out, et cetera?
Yeah, it's interesting because, that unicorn company you mentioned in Korea, it's a good example of how every big winner that we've ever backed, it seems like the business that ends up creating the most shareholder value is really not the business we invested in. I mean, these businesses evolve, and, some people call it pivots. You could call it an evolution. But Coupang is the company. When we invested, it was in 2011, and they got started in 2010. As a Groupon clone, and it was one of dozens and dozens of Groupon clones that started around the world. I'm sure there are many that started in India. Around the time that Groupon was going public, they came to Korea and they looked at potentially acquiring us, and they said, oh, we're either going to acquire you or crush you. And it's like, wow, okay. And they decided to actually try to crush us. They started a Groupon Korea division and put lots of money. And a few years later, they basically shut it down. And Coupang has evolved to become the Amazon of Korea, and I would say the Amazon plus UPS of Korea, because they're developing the entire logistics infrastructure for same-day and next-day delivery. And the company is now worth more than Groupon on a global basis, right? When not that long ago, they said they were going to either buy us or crush us. Maybe they were thinking about buying us for maybe $300 million. So it's quite interesting. Another good example of a company that completely pivoted is a company we invested in 20 years ago called Vesta. I think I've talked to you about this company before. They started in the prepaid calling card business, and again, that business wasn't going that well, so they decided to sort of take advantage of this fraud detection technology they had. Because when you're doing prepaid cards and you replenish these prepaid plans using credit cards, there could be some fraud using stolen credit cards. They decided basically to use that fraud technology to become a financial transactions company, and they indemnified their customers, and we have big customers like AT&T, Verizon, T-Mobile. We indemnify them of all the fraud risk. And they grew very, again, capital efficient manner. They made the Inc. 500 Hall of Fame. To make the Hall of Fame, you have to be on the list 5 years in a row, which is hard because as you get bigger and bigger, it's hard to continue to grow in that percentage growth rate. and Inc. 500 is not based on size, but purely based on percentage growth rates. And so that's an example of a company that the business is unrecognizable from where it had started with, right? And so I think that's a common pattern we see in a lot of big winners.
Last question. Are there areas that you've identified as promising areas where you can build fast growth, large companies that you're looking for companies in?
Yeah, there are always some new areas that we try to learn about, and we usually post them on our blog. Like one example, the most recent blog post I did last year was on vertical market opportunities, which we believe is a $1 trillion opportunity, and the main reason is if you look at the vertical software category, it's a $100 billion category. You know, selling to medical and construction industry and you know, government and so on. The $100 billion is a pretty interesting number because it's much bigger than the operating systems and databases and other, even ERP, other categories. Yet, if you look at these vertical markets, most of them are still operating with paper-based manual processes. They really have not adopted technology. And so we think the opportunity still in these vertical markets is much bigger than the current $100 billion opportunity. If you're a entrepreneur trying to disrupt, rather than trying to be a disruptive force into that $100 billion existing category, which is a bunch of legacy systems, if you go after all the paper-based systems, that's an order of magnitude higher, right? So that's why we get the trillion. It's at least 10x higher than the $100 billion. That's $1 trillion opportunity. And the term sheet we just signed for a deal in New Orleans is a company that's in the vertical market category.
Very good. Well, thanks for coming. I know we had a little bit of a glitch here and there technically today, but I'm really glad that you were able to make it and we were able to capture your perspective.
Great, my pleasure. All right, thanks. Talk to you later.
Bye-bye.
Bye.
Folks, I'm going to take you through a few minutes of discussion about the 1M1M program and then hopefully have some time for Q&A. So if you like what we are doing here in this program, please refer other serious entrepreneurs into 1M1M. We are looking for serious entrepreneurs, and the word serious is really important because entrepreneurship is not a fly-by-night affair. It's a lot of very hard work over a very long period of time. You heard Ho talk about companies that they've been with for 20 years, and that's, you know, a lot of time, a lot of, you know, years of your life. So 1 million by 1 million, everything, all our resources are at 1mby1m.com. You'll find a blog that is very rich and a great learning resource. You'll find the Entrepreneur Journeys book series. All of those books are available on Amazon Kindle. And you'll find a ton of information on our website. There are videos, video FAQs, etc., that you can figure out whether this program is for you, and you're going to be able to get in tune with the kind of content that we provide and the kind of lessons and guidance and philosophy that we work with. I've talked about some of that with Ho today. You got a flavor of our, you know, capital efficient entrepreneurship philosophy. These roundtables happen almost every week on Thursday mornings, 8 a.m. Pacific time. So please keep coming back, and if you want to pitch, register to pitch, or just keep following the roundtables. You'll learn a lot just by simmering in these sessions. And of course, the recordings are available. And then we have the premium program, which offers you extensive methodology guidance, a full curriculum, and this is over 300 hours of curriculum that includes over 700 successful entrepreneurs and investors and so forth who have participated in developing this curriculum. You get their perspectives, their guidance. You get help with business development. We introduce you into our Rolodex, which is extensive. We help you with strategy consulting, and we also help you with financing and media relations. The premium program is a $1,000 annual membership fee. You'll find the $1 Million Club link on our website, where you'll find case studies of success stories from the program, and you'll also find a link called Quantifying the 1M1M Value Equation, which offers you ROI of the 1M1M program, which is $375,000 plus 5 to 10% equity worth of value for just a $1,000 annual membership fee. The 1M1M self-assessment is something that I suggest you take a look at. It's a bunch of questions that you need to answer. In building your strategy, you're going to need to answer these questions extensively and precisely such that you have strategies on every single dimension that this questionnaire puts you in front of. Also, as you're going through the self-assessment, if there are knowledge gaps that you identify of where you need help figuring out how to do a certain piece of analysis, you can just go to 1M1M Basic, which is a curriculum-only subscription. It's a monthly subscription, $99 a month. And Maureen can put the link on the public chat. And sign up for just that product, and you can get access to the entire 1M1M Basic curriculum through that. So that's pretty much it. You can dig around on the website and look at what to expect from the premium program, from the basic program, et cetera, and decide which of the offerings is the best for you. There are tons of FAQ videos. Our program is taught in case studies and video lectures, and we've had over 700 successful entrepreneurs, investors, et cetera, participate, as I said. So you learn from a very, very rich set of people who have generously brought to you the perspectives and the success strategies that they have been successful with and failures that you can avoid based on experienced people's advice and experience. So that's pretty much all I want to share with you. We've talked quite a bit about all the other topics, and I'd like to get to Q&A next. So by the way, the next 4 weeks we have roundtables. After that, we're going to have a bit of a gap because I'm traveling, but the next 4 weeks we have these free roundtables. Please feel free to come and participate in these roundtables. Let's do a little bit of Q&A. We have 5 minutes left on the show. Let me see what questions have come up here in the public chat. You can ask in public chat. Also, you can dial in, whatever you prefer is fine. Josie Aberdeen has been asking, what could KB from Ever Bamboo have to do to make his company fundable? How much revenue would he have to generate to become fundable? That's not the point, Josie. Companies that are deemed fundable tend to be companies that are addressing a very large market opportunity, billion-dollar market opportunity, and are growing at a very fast pace, 100% year over year. And neither of those metrics are valid in the case of KB's Ever Bamboo company, because it's been 10 years that he has been doing a $200,000 company. That will not qualify as a fast growth company. Abi Karigudia is asking, can you share any experiences in life science and medical device companies, how you help market validation, expansion, and financing? We don't work in life sciences and medical devices. The only one we work with in the healthcare area is healthcare IT. We work only in IT and IT-enabled services, so medical device and life science are not within our scope of expertise. Josie Aberdeen is asking, thank you for inviting me to this roundtable. It's excellent. You're forthright. Appreciate that. My question is, how does one decide how to price an item, especially if you do not want to do the now conventional 3 or 4 or 5 options, but you want to have only one main price? You know, just because you have 3 or 4 price options doesn't mean you do not have one main price. Just options is one thing. You can provide options, but you can always steer people towards the main price just by making that one main price more attractive. We have a whole module on pricing, so it's kind of difficult for me to cover in 2 minutes the whole pricing strategy module, but you can, if you want to do the curriculum, you will be able to access the module and learn from there. There's somebody, Seshu Madabushi, who's asking, do you always need a co-founder to scale to 1 million in revenue? No, you don't. We are actually perfectly comfortable with solo founders. We encourage solo founders. I don't think there's any problem with solo founders. I know tons of solo founders who have done, you know, $3 million, $5 million in revenue just as a solo founder with very small teams. So it's very doable. It really depends on the business. Vishnu Gupta is asking, we are a startup in the higher education space. I'm attending your roundtables to get a feel of the right pitch and learn the kind of questions I will be asked from investors. Vishnu, do the self-assessment. All the investor questions are summarized in the self-assessment on our blog, on our site. Puneet Patel, in the one-on-one program premium, would you coach the entrepreneur through the live conferences like this? Also, would you guide the entrepreneur through the funding landscape? Absolutely. There's extensive coaching. So what you're going to do in the premium program, Puneet, is you're going to work in tandem with the curriculum and these roundtables where I'll coach you on the project. So as you're working on specific issues, whether it's finance, there's a whole financing module that you're going to do offline, and then you're going to come to the roundtable and we're going to work live on those topics. So whether it's positioning, whether it's financing, whether it's bootstrapping, all of those things we deal with on a regular basis in the roundtables, and you're also going to have the learning material to refer back to as you're going through each of those issues. KB Lee has the same question. Okay, great. So Josie already asked you a question. Who else? Any other question? Question, comments, issues? Let me introduce you to Irina Patterson. If you have questions about the 1M1M program, you can reach out to her, irina@1m1m.com. She'll be happy to get on the phone with you as well. Anthony Yao is asking, to get to an MVP, what steps do you recommend? Anthony, our philosophy is do not do any software development until you have validated the business case for your product. So before you develop the MVP, I would like you to actually validate the business case of whether it's worth building an MVP at all. And all that we teach you in the 1M1M program. So sign up for 1M1M Basic or Premium, and we'll coach you through the whole process. Anybody else? Any other questions, comments? All right, folks, thank you for coming. Hopefully we'll be seeing you next time. And some of you, even before that, as you come into the 1M1M Premium or Basic program, we will start working with you and making lots of progress. Good luck, and see you soon. Bye-bye.